Hello, and welcome to episode 131 of the REconomy Podcast, where we discuss economic issues that impact real estate, housing, and affordability. If you find this type of real estate economic discussion valuable, please be sure to hit the like button and subscribe to help us grow this podcast. I'm Odeta Kushi, Deputy Chief Economist at First American. Here with me today is Chief Economist Mark Fleming and Xander Snyder, Senior Commercial Economist at First American. Hi, Mark. Hey, Xander.
Hi, Odeta, and hi, Xander. We are now in the middle of the holiday season, and as the end of the year draws near, we economists like to look ahead to the new year and make some informed guesses, otherwise known as forecasts, about what it'll look like. And today, Xander is joining us to go over First American's commercial real estate outlook for 2026.
That's right. Did everyone bring their crystal balls for this episode?
Yeah, mine's around here somewhere, but I will make the typical obligatory comment about mine being a little bit cloudy these days, but we will charge ahead anyway. Today, we're looking ahead to 2026 and asking a big question for commercial real estate. Is 2026 the year that the recovery actually starts to feel like a recovery?
Yes, indeed, because after a few years of interest rate and demand shocks, falling prices, and lots of uncertainty, people are wondering whether we're still in the storm or finally seeing clearer skies. There's going to be a lot of meteorological analogies today. Maybe a less cloudy crystal ball, Xander?
Yeah, and I'd say that the answer is we're not in the all clear quite yet, but the data is telling an increasingly compelling story that the new commercial real estate cycle has begun in earnest. So today we're going to walk through 5 different forces that are shaping our 2026 commercial real estate outlook. What's happening with prices, sales, refinance volumes, distress, and lending activity, and what that means for you if you own, operate, or lend in commercial real estate.
So let's start with the big picture and then work our way through those 5 forces one by one. Xander, in 2024, I remember you borrowed the phrase stay alive till 25 and then added stay in the mix till 26. Do you feel like that line has held up and is still an accurate representation of where we're heading?
Yeah, I think so. And I think it's helpful to think about commercial real estate in terms of this business cycle. After all, commercial real estate is a cyclical industry. And after the long expansion that followed the global financial crisis, COVID and rate hikes finally triggered a downturn. So 2022 to 2024 were those downturn years. But in 2025, prices stopped falling and distressed assets began to change hands more regularly. So the first of these 5 forces then is price stability, which is what happens at the end of one cycle and the beginning of the next one. And price stability came to us in 2025, and this is going to provide a more solid foundation for robust market activity next year that didn't exist at the beginning of this year.
So no flip the switch sort of moment as we enter January of 2026, but more activity is coming, and we're not catapulting back to levels seen since mid-2021.
Exactly. Commercial real estate is a slow-moving industry by nature. And one side effect from this, I think, is that people often expect commercial real estate trends to unfold faster than they actually do. So today, transaction volume is still below pre-pandemic norms, but above where they were last year in 2024. In other words, buyers are coming back to the market, just not all at once.
That makes a lot of sense. Price stability is usually a precondition for significant levels of activity in real estate markets. You know, when prices are falling rapidly, buyers wait for a better deal and lenders pull back because no one wants to catch the proverbial falling knife. Once prices flatten out and start to increase modestly, then confidence improves.
Right. And this increase in sales volume is the second of the 5 forces that we're going to talk about today. And though it's been gradual, it's also been persistent throughout 2025. So sales volume has climbed from its lows and is now running above 2024 levels and has been for all quarters this year, even though we're still below that pre-pandemic benchmark.
So we're not in boom times, but it is a clear improvement from where we were just last year.
Right. Yeah. Think of this as moving from skepticism to cautious participation, cautious optimism. Buyers don't need a storm-free outlook with perfect certainty to re-engage with the market, but they do need a sense that price declines are largely complete. As more transactions occur at these new price levels, it reinforces that signal. Appraisers get more comparable transactions, lenders get more comfort, and everyone starts to have a better sense of what properties are actually worth.
Okay, so then what does that mean for investors who've been sitting on the sidelines looking for that more increased certainty in prices?
Well, if you're well capitalized and patient, this is the moment in the cycle when opportunities really start to appear. Indeed, a lot of the best investments that occurred in the last cycle were made in the early phases in 2011, 2012. The key now is that the price floor looks more credible than it did a year or two ago. This is now drawing that purchase demand back to the market. And there is quite a lot of dry powder. And by that, I just mean liquid equity capital that's sitting on the sidelines ready to invest. That dry powder has been basically ready to deploy and is just looking for discounted assets. And now it's going to have that opportunity to get back in there.
All right, so we've gone through the first two forces, but what about the third force, refinancing activity? Clearly, in the residential world, refinancings are down significantly compared with pre-pandemic because so many people have below market interest rates. But in the commercial real estate world, borrowers face balloon maturities when all or large portion of the debt must be refinanced at a given point in time, rather than amortizing equally across a long-term schedule. So how are things unfolding now as those loans start to come due?
Yeah, balloon maturities are one of the key differences between commercial real estate and residential mortgages. And they do help to explain, at least partly, why refinancing activity rebounded faster than sales. And again, in the commercial real estate world. And in short, when a loan comes due, you're forced as an owner to make a decision because there is a large lump sum payment owed to the lender on a certain date, unless it's refinanced. This never really occurs in the residential world, or at least not in the US in the residential world. So, like sales volume, refinancing volume fell sharply in late 2022 through early 2024, but that's turned around fairly substantially now. From the low point of the first quarter of 2024, when refinance volume was around 55 billion, it is now more than doubled, reaching about 114 billion by the third quarter of 2025. So this is in line with levels of refinancing activity seen in 2019 and 2021. And it's worth mentioning the balloon aspect because that is essentially driving this activity, at least in part.
That's a big shift back to essentially pre-pandemic and early pandemic levels. When refinancing volumes do recover, it tells you three important things. First, at least some borrowers are finding ways to make the math work at higher interest rates, whether that means fresh equity, as lenders require more, quote, skin in the game from the borrowers, lower leverage, or more conservative underwriting. Second, lenders are once again comfortable refinancing rather than defaulting to extend and pretend forever. And third, some borrowers simply reached maturity on their loans and had to do something about it one way or another. Still, the key takeaway from this third force is that the refinancing pipe, if you will, is flowing again. It doesn't mean every loan gets saved or that every borrower is happy with the terms they can get on a new loan, but it does mean the market is better able to sort out which properties are viable at this early phase of the new cycle and which need to actually change hands or be repurposed.
All right, so I think we've covered the first three forces here. We had price stabilization, rising sales, and refinance volume. And this actually sets the stage for the fourth force, distress. We've all seen headlines about office properties handing back the keys and delinquency rates rising. Where are we in that process of loan distress and resolution?
Well, distress is ongoing, and we do expect it to continue but peak in 2026 and then subsequently gradually recede. And part of this is because the share of distressed sales relative to all sales is rising, which means that more of the distress is gradually beginning to be drained out of the other end of the distress pipeline by new buyers who are able to enter into new cost bases when they acquire these assets at a cheaper price point. In these cases, some resolution is being reached, although that resolution may still involve the prior owner losing all or much of their equity. But it's a resolution nevertheless, and it adds to the liquidity in the market. Now, office remains under the most intense pressure. Distress levels are near record highs, near where they were after the global financial crisis. Multifamily is also showing some stress in certain corners, especially for deals that were underwritten with very aggressive rent and cap rate assumptions during the low rate years.
So, in the blog post that you've written covering this outlook, you included a chart showing commercial mortgage backed securities or CMBS delinquency rates. It showed delinquency rates for office CMBS loans continuing to reach new highs and certain types of multifamily CMBS continuing to climb as well. Retail delinquency rates continue to move sideways and sit a little above 4%. But CMBS are a type of commercial mortgage that's unique from others in that it's securitized, which means that the loan is sold off in chunks to several investors. I think this raises the question, do CMBS delinquency rates tell us what's happening across the broader CRE debt universe?
It's a good question. And I think that CMBS delinquency rates tell us something, but they don't give us a full picture. When we look at historical delinquency rates after the global financial crisis, we see that bank loan delinquency rates did reach nearly the same level as CMBS loans, but they were somewhat lagged behind CMBS delinquency rates rising. Today, by contrast, CMBS delinquency rates are very elevated, but bank delinquency rates remain lower. And this is in part because banks have more flexibility when it comes to modifying loans. CMBS structures make loan workouts and restructurings quite difficult. So stress tends to show up in that world first.
So CMBS data or delinquency data shouldn't be read as a one-to-one indicator for all CRE debt stress, especially since CMBS is actually only a small share of all commercial real estate mortgages at around 15%.
Exactly. CMBS delinquency rates are directionally informative and a useful early warning indicator, but they're not representative of the average commercial real estate loan. At this point, most distress situations out there, I would say, have already been identified. And as lenders work through them, we do expect distress to peak in 2026 and gradually ease. Part of that will be bank loan distress gradually rising following those CMBS delinquency rates. That said, as we move throughout the new year, we will still be talking about distress, especially in office and multifamily. But the narrative will gradually begin to shift from stress building to stress being worked through, with lenders increasingly freeing up balance sheet capacity for new loans as they resolve legacy loans.
So, that link between distress helping the lending outlook might feel at first glance a bit counterintuitive, but it is a matter of balance sheet capacity. When banks resolve loans that have been stuck in amend and extend mode, they free up capital to make new loans.
It's kind of like cleaning out your closet, painful to get rid of things you overpaid for, but once you do, you have the space for new items that actually fit your current needs.
Okay, I feel like that was directed towards me, but I'm going to let it go. Now, this brings us to force number 5. Lenders are re-engaging. As distress is resolved, banks free up balance sheet capacity to make new loans.
That's right. Commercial real estate lending has regained meaningful traction. In the third quarter of 2025, lending origination activity for most major lender groups increased compared to the prior year. Life insurance companies were the one notable exception. They ticked down gradually by a few percentage points compared to last year. But the broader story is that lending activity is improving right now rather than slowing.
So lenders are slowly shifting from defense back to offense, even if underwriting is still tighter than in the ultra low rate era. So stepping back a little bit, when you combine these 5 forces, what's your overall view of 2026?
Well, I'd say that it looks like this nascent recovery will gain momentum next year. We'll exit from the transition phase and enter into an acceleration phase of this new commercial real estate cycle.
So CRE is once again behaving like a cyclical asset class rather than the shock victim of the pandemic. Prices are adjusting, capital is reallocating, and fundamentals are reasserting themselves. That's what a well-functioning market looks like, right?
That's right. And Xander, if you had to leave listeners with just one takeaway from the 2026 outlook, what would it be?
Well, I'd say that we've moved past the wait and see phase. 2025 was really the handoff year, and 2026 is when the news cycle is going to start to look real. That doesn't mean charge ahead blindly, but it does mean that the menu of opportunities will get more interesting for investors who can underwrite to today's environment rather than yesterday's.
That's great. Well, thank you for joining us, Xander.
Wait, hold on a
Yes,
second.
Mark.
There is absolutely no way that we go through this episode without one 80s reference. I can't let our listeners down like that at the end of the year, right? So next year, May the five forces be with you. All right. Now, this is originally 1977 Star Wars. I saw that movie with my aunt, and I know the phrase, may the force be with you, is in that one. But in my defense, you have The Empire Strikes Back from 1980. You have Return of the Jedi from 1983. Need I keep going?
Well, depending on which movie, it could also be a 90s or 2000s reference too. So I guess it's an intergenerational reference to cap off the year. Yes, may the forces be with you all.
I love it.
Thank you for joining us on this episode of the REconomy Podcast. If you have an economics-related question you'd like us to feature in the future, you can email us at economics@firstam.com. And as always, if you can't wait for the next episode, you can subscribe to our Econ Center at firstam.com/economics or connect with us on LinkedIn. Until next time.